Good morning, everybody. It's Friday. It's the end of almost the end of another week. We're going to be talking about interest only loans today. I bet you never thought you would hear me say interest only loans are a good loan. But listen, it used to be that that's all we had. Prior to 1936, most mortgages were interest only mortgages. And then after the crash of 29 and the ensuing the depression, the interest only loans were put on the shelf and replaced with self amortizing 20-year mortgages. Now, when the government steps in, and so when the government or banking steps in to make things better, you often find out that what you had worked really well if you only knew how it worked. Would you like to know how interest only loans actually work? I need you to stay tuned. Here we go. Good morning, good morning, good morning, everyone. My name is Don Daniel, founder of P.I.L.L Method International, a better way to eliminate debt. P.I.L.L stands for prepayment of principal, isolation of principal amounts, leverage, and liquidity. Once you understand these four principles, you can get a handle on how loans actually work. And that's why we exist. We want people to know how money actually works for you instead of the bank. Let's look deep inside what's really happening so that you can know how to make the most of your money. Every one of your dollars, every dollar you have should be working as hard as it possibly can. I mean, you should optimize the use of your money. Optimize how much interest you save. I mean, you can cut your interest costs down by 75% if you knew just what to do. So we're going to be talking about something very interesting here. And what seems to be a negative turns out to be a great positive, an interest only loan. Let me put something up here. Somebody said, Don, can we really get interest only loans? I mean, is it really a good thing? I mean, can you get it from a real, a bank that I recognize? You most certainly can. Let me put it on the screen for you so you can see what I'm talking about. Okay, so here we go. And can anybody recognize this bank? Does anybody recognize this particular bank? All right. Chase Bank, what is an interest only mortgage? An interest only mortgage. And we're going to break this down so that it can be understandable. All right. So it says a 5-minute read here. And I'm thinking maybe I'll listen. We're going to give this to you. All right. So where's that? How can I get to that website? So we're going to copy that and I'm going to put it in the comment section here. All right. We'll paste it in there. That way you can have it. Okay. There it is. You can have that. All right. And maybe we can get Ruby to copy and put it in a little bit later so we can have that as well. All right. So what is an interest only mortgage? Okay. And how it works. So let's see. Most interest only loans are structured as an adjustable rate mortgage. All right. So right now we got two things that seem negative: adjustable rate mortgages and interest only mortgages. All right. So I need you to listen closely because There is something about interest only mortgages that most people don't know. And the ability to make interest only payments can last up to 10 years. After this introductory period, you'll start to repay both principal and interest. The interest rate on an ARM loan can increase or decrease throughout the length of the loan. So when your rate adjusts, your payment will change too. When most people read that, you know what they read? My payment is going to go up. If the interest rate goes up, my payment is going to go up. How would you like to know if the interest rate goes up, you're still in control of what your payment is going to be? With an interest only loan, you are in great control of what's going on. So when you read this, you got to look deeper. So what else does it say? For example, if you take out $100,000 interest only ARM at 5% with an interest only period of 10 years, you'd have to pay about $417 per month towards the interest for the first 10 years. Now, here is the thing. When you see interest only, it doesn't mean interest only. Now, what are you talking about? It says interest only. What do you mean it doesn't mean interest only? I'm going to save that for a little bit. You're going to love this part. When this interest only period ends, your monthly payment amount will rise substantially with the inclusion of both principal and interest payments. That's true. Okay. Additionally, if the interest only loan is also an ARM, the payment amount may also fluctuate due to periodic interest rate changes. Okay. Why get an interest only loan? I need you to focus on this. Listen, I thought I would just get this from Chase. Let me make this a little bit bigger. Uh-oh, I hit the wrong button. Let me see here. I hit the wrong button. There we go. Here we are. This is the right button. And we're going to make that just a little bit bigger for everybody. Okay. Why get an interest only mortgage? If you're interested in keeping the month-to-month house costs low, all right, number one, your housing costs are lower. Housing costs are lower, all right? An interest-only loan may be a good option. If you want to keep it low, an interest-only loan could be a good option. Common candidates for an interest-only mortgage are people who aren't looking to own a home for the long term. I'm going to push back on that. You can get an interest only loan even if you want to keep it long term. Okay. They may be frequent movers or are purchasing the home as a short term investment. That's true. That's true. All right. If you're looking to buy a second home, you may want to consider an interest-only loan. Some people buy a second home and eventually turn it into their primary home. Making payments towards just the interest may be convenient if you aren't permanently living in the home yet. So what they're saying is, if you've already got a mortgage and you purchase a second home, then having the lower interest-only payment could work in your favor. All right. So I haven't gotten to the good part yet. I'm just setting this thing up so that you can see everything that's going on. This is how most people believe about interest-only loans. Okay. Now, what else does it say? While an interest-only loan may sound appealing for people looking to keep their payments low, it can be more difficult to get approved, and it's typically more accessible for people with significant savings, high credit scores, and a low debt to income ratio. So keep that in mind. All right. Keep that in mind. Now watch this. The pros of an interest only loan. This is the part I've been waiting for. I want to share this with you before I actually start showing you some numbers. So start inviting some people in. If you're watching us, listen, if you're watching us on YouTube, then you definitely want to subscribe. You definitely want to like the videos and share this information with others. Now, why do you want to subscribe? Why do you want to like the videos? Because it helps our algorithm. The algorithm loves that, and more people get to know more about what we're doing because you have decided that you wanted to participate in helping to get the word out. All right, so that's how you do it. Subscribe, like, and share. All right, there you go. All right. Oh, don't forget to comment on these videos. So if you like what you see, if you like what you hear, let's leave some positive comments as well. The algorithm loves that. Okay, watch this now. Interest-only loans may make financial sense for some borrowers because of these things. The initial monthly payments are usually lower since you're only making payments towards interest the first several years. Your monthly payments are usually lower compared to some other loans. That's true. May help you afford a pricier home. All right, you can get into a pricier home because you're trying to keep your payments low, and now you can get the home that you want, all right, instead of the home that you have to settle for. All right, watch this. You may be able to borrow a larger sum of money because of the interest-only payments during the introductory period, which is about 10 years. All right, so keep that in mind. I'm writing that down. Payments are lower. Number two, your introductory period is only about 10 years that you can make interest-only payments, and then your payments will switch over to principal and interest after 10 years. Okay, so keep that in mind. Okay, now this is the part that blows people's minds, starting right here. An interest-only loan can be paid off faster than a conventional loan. What? Yes. An interest-only loan can be paid off faster than a conventional loan. And I am going to have the privilege of showing you some of those numbers. Oh, can't wait. If you're making extra payments towards an interest-only loan, oh my gosh, here it is. When it says interest only, it doesn't mean interest only. That's what I'm talking about. When you have an interest-only loan and your minimum payment is interest, just the interest, you're not prevented from putting money on principal. And in fact, remember, if you've heard my videos, seen my videos before, you've heard me say that control the principal payment and you control the loan. With an interest-only loan, you are in complete control of principal payments. Therefore, you are in complete control of this loan. More control than a principal and interest loan. Now, it may not seem clear to you right now, but listen, come into the studio, come on stage. All right, come in here and start and ask your questions. I want about it. Listen, especially if you're a mortgage lender, a real estate investor, if you are a real estate agent, come on in, click on the link, come on in. We want to talk to you and bounce some of these ideas off. All right, it's very important that the general public understand the benefits of an interest-only mortgage this morning. Okay, so let's get back to our study. It can be paid off faster if you're making extra payments towards an interest-only loan. The lower principal can generate a lower payment each month. Oh my gosh. If you have an interest-only loan, meaning your payment means that it is the interest portion that would be due on the loan. All right, the interest portion that's due. So we're going to show you how to figure that. right? So if you have the interest portion, all right, that's due, and it's based on how much you owe, what happens if you lower how much you owe? Then your payment would be lower as well. How about that? Not only can you pay the loan off faster, you can control how much your minimum payment will actually be. It doesn't have to stay the same. Oh my goodness. When it comes to a conventional loan, extra payments can reduce the principal, but your monthly payment remains the same on an interest on a regular self-amortizing mortgage. Okay. On a regular mortgage where you pay principal and interest, no matter how much extra money you pay towards the loan, your payment doesn't change, and you still have to make a payment every single month. You just make it for fewer months. That's what our clients do. You can actually pay off a 30-year mortgage in an average of 7 to 9 years. Okay, so let's see. Possible to increase your cash flow. All right. Lower monthly payments can leave you with a few extra dollars in your budget. All right. Because if you are a real estate investor and you're trying to increase cash flow, you want to create some distance between how much your payment on the mortgage is and how much rent you're receiving. What if you could lower your payment so that your cash flow is increased because your mortgage payment is decreasing, but your rents are increasing, or at least stays the same? You can create more cash flow. Does that make sense? Okay. All right. Rates may be lower. All right. Your interest rate could be lower because it's an interest only loan, because most people don't understand. Do you know that most people who get an interest only loan, all right, and if they keep it long term, they will pay interest only for the first 10 years and not put a dime on principal because they think they cannot do that. I'm talking to some people right now who have actually done that. They had a term for interest only and they kept paying interest only. All right. So you can get rates to be lower. And I'm going to show you some things about interest only loans that you didn't know. I'm going to show you some stuff in just a minute, but I wanted to take the first 15, 16 minutes to go over the basics, just in case somebody had to leave and they like shorter videos. But now we're going to get into some of the numbers, and we're going to dig down deep into interest only loans. We went over the cons. When we come back from our break, we're going to go over some of the cons of interest only loan and how we can put the whole package together. And I can show you why I love interest only loans. Be right back.
Listen to me, y'all. But one of his mentees took us through one of their programs, and I paid off my mortgage. But guess what happened? My marriage went to a whole nother level. And you know why? Because my wife is a security freak. And even when I blew up, my wife would be like, oh, you blew up, but how long is you gonna keep making this kind of money? I was like, I don't know, forever. She's like, you sure? Because I'm gonna keep my license as a nurse just in case you don't. So when I paid the house off, my boy was like, you ain't gotta do that, you can do this. But when I paid the house off using that program, it took the stress level all the way down from my wife because we no longer had a mortgage. Does that make sense? That thing that was coming every month, that was getting on her nerves, we didn't have that no more. And so she was at rest.
All right, folks. So let's go over the cons and then I get into some of the numbers. All right. But the cons really aren't that bad because we know that we can overcome them. Here they are. All right. Choosing an interest only loan. All right. Could be a risk for borrowers. Some cons that with this type of loan include, just some of the things that it includes are this. You're not building equity in the home. And that would be true. If you just pay interest only, you're not building equity. But It doesn't prevent you from building equity. We just found that out. You can build equity faster and cheaper, equity faster and cheaper with an interest only loan if you know what to do. But if you just pay interest only, you're not building equity. Here's the next thing. You can lose existing equity gain from your payment. If the value of your home declines, this may cancel out the equity you had from the down payment. Losing equity can make it difficult to refinance. Okay, so here's what it's saying. It is possible that in any type of economic climate, you can stay ahead of bad things happening. What if there is a downturn in the economy and property values decline? If you have the P.I.L.L method, you would be gaining equity at 5 to 7 times the regular rate. Okay, so no matter what happened, you would be further along in your mortgage, and you would have more equity in less time at a much lower cost. It's not just enough to pay more. I need you to focus here. What you want to be able to do, ladies and gentlemen, is get optimum use of your money. You want your dollar. You want your dollar to save you the most interest you possibly can with that dollar. And the only way that you can do that is optimize, using the right amount of money in the right month on the right day of the month, and apply to the right loan so that you can eliminate the maximum amount of interest that's mathematically possible for you. Anything can be optimized, but you know what can't be optimized? Things you cannot measure. If you can't measure it, you can't optimize. And we're taught not to measure our outcomes when it comes to mortgages. We're not taught to measure how much interest we're paying at any given month. And we're not taught to measure how much interest we're saving if we choose to prepay. We're not taught to measure that. But what if we had a way to measure it? That's our opportunity cost calculator that does all of that measuring for you and make sure that you pay in the right month, not every month, but the right month. Strategic times throughout the year, you can save tremendous amounts of money by paying the right amount at the right time. It's all math. It's not magic, but it's definitely math if you understand what's going on. So let's read the rest of this. Okay. Low payments are temporary. Low monthly payments for a short period of time may sound appealing, but they don't last forever. It doesn't eliminate the eventuality of paying back your full loan. Once the interest-only period ends, your payments will increase significantly. Interest rates can go up. Interest-only loans usually come with variable interest rates. If rates rise, so will the amount of the interest you pay on your mortgage, but that's wherever the mortgage is. So we're going to look at the pros, we're going to look at the cons, and see how we can control all of that. So keep this in mind. We're going to go back over this. I'm just going to pull up a calculator here, put that on the screen. All right, there it is. We got a calculator on the screen, and I want to show you some things. First, I got my calculator ready, but first, I want to bring up Mr. Brett Whistle, all right? And we're going to show you some stuff about how these loans operate. Can I show you? All right, so if you go in here, let's put in a $420,000 loan, all right? $420,000 at right now, interest rates are right at 7%. Here is your payment. $2,794.27. Okay, that's your payment. But if you scroll down, you can also see the interest-only payment, which is $2,450. All right, $2,450. I want to show you something. So you can get, even if you have an interest-only loan, you can get an amortization of 30, 20, 25 years, or even a 15-year amortization, so that when the 10-year period runs out, then your principal and interest will be based on that particular term. Here's what you need to find out. Always, always, always choose the longest term. Never get a shorter term. Okay, here's why. I'm going to pull up a few of these. All right, so that's two. And so this is a third one. Okay, there we are. All right, so in this one, this is a 30-year term. All right, so but in this one, I'm going to change the term to 300 payments. Okay, that takes off 5 years. So this now is a 25-year loan. 25-year loan. Okay, I need you to see something here. What is the first interest payment? It's $2,450. On the 30-year loan, what is the first interest payment? $2,450. It's exactly the same. Exactly the same. All right. So that is the interest payment. So if it's going to be the same, so it can't be the same if it's a 15-year loan, can it? All right. So we got a 30. We got a 25. Let's just go all the way down to a 15-year loan. Put in 180 payments. Calculate that. Okay. And our regular payment would be $3,775.08. But 180 payments, that's 15 years. Look here, interest only payment, $2,450. So get your interest only loan and make sure you get the longest term available, because no matter what your term is, your interest payment will remain the same. Now, how does that work? If your interest payment remains the same, because the math dictates that the interest payment is the same on a certain amount of money. Here's what we're looking at. Now I'm going to bring up my calculator. Let's go back here because I don't want to get confused on anything. So we're going to get rid of some of this advertising here. So we have a $420,000 loan, right? At 7%. I'm going to show you an easy way to figure this out. You take your 7%, 0.07. If you want to do your own interest only calculation, 0.07, all right? You divide it by 12. And that is your monthly interest rate, 0.0058 and a bunch of threes. Now you take that and multiply it by your balance, which is $420,000. So we're going to multiply it by 420. There we go. Equals $2,450. So I need some help from the audience right now. If you're watching us on YouTube or Facebook, I need you to put a number in for me. How much do we want to add to this loan? I want to pay this loan down some, and I want to show you what happens when you do. Somebody give me. I'm going to take the first numbers that come in: 1,000, 5,000, 500. Give me a number so I can put it as a prepayment to this loan to bring the balance down, and then I'll show you what happens to the interest. Okay, brother AJ, I'm going to add $350. Okay, so we take our $420,000. Okay, we made our interest only payment. All right, and then we're adding another $350. So we're going to subtract $350. This is our new balance, $319,650. Okay, let's make a note. 419,650. $22,650. That's our new balance. So remember, an interest-only loan is based on how much you owe. So if we take we're going to take our point, come on, we're going to take our 0.07, our 7%, divided by 12, and then multiply that by our new balance of $419,650. Okay? 2447.96. So here is our old payment, 2450, and do you see that our payment is actually lower now, $2,447.90. It says 958, so we have to round this 5 up to a 6. Okay, that would be our new interest only payment. Does that make sense, everybody? You are in control of an interest only loan. So now, how many of you that are familiar with the P.I.L.L method? Now remember, it says that you have this loan for 10 years. You have this loan for 10 years. You know you can prepay. All right. You know you can lower your payment if you need to. Let me ask you this. If your regular payment was $24.50 and each time you put money on principal, okay, each time you put money on principal, but you kept the same payment of $24.50, the interest part would keep going down as you can keep basically the same payment, $24.50, but more of your regular payment of your $24.50 would now go to principal automatically. Your regular interest only payment more of it would go to principal because periodically you're putting money on principal, lowering your minimum payment. You are complete control of this loan, complete control. All right. So now, if you are aware of how we do business here at the P.I.L.L method, our average client pays off a loan in how many years? I'm going to wait for somebody put it in the chat, right? Our average client pays off a loan in how many years? Put it in there. I'm going to wait and see. Wait and see. I wish somebody would come into the studio so that we can talk. That would be great. All right. So let me see here. We're going to add this. All right. Somebody said 7 years. That is correct. All right. 6 or 7 years. All right. So now, if we have a situation where the interest only period lasts for 10 years and the average P.I.L.L method client pays off their mortgage in 6 or 7 years. Brenda Jackson said 7 to 9. Okay. 7 to 9 years. Okay. There you go. Oh, Brother AJ, don't start laughing now. Brother AJ, why are you laughing? I wish you would come into the studio. All right. He said, listen, if I get an interest only loan and the bank is looking for me to pay just interest for 10 years and then change over after 10 years to principal and interest so they can make more money, a P.I.L.L method client will take this loan and be done in 7. Brother AJ says, I'm heading to work in 10 minutes. Oh man. Okay. All right. Well, listen, the next time we're in here, you need to say, okay, I'm going to spend at least 5 minutes with Don before I go to work. Just come in at the beginning of the hour. I'm going to be back here on Sunday. All right. So Sunday. Speaking of Sunday, you don't want to miss Sunday because we have an expert coming in that's going to teach all of us how to become a business loan broker. You can lend up to millions of dollars, make a very good income, no license required. And we're going to give away enough information for you to get started lending millions of dollars for free and introduce you to a couple of private banks that do these types of loans. and they need brokers like you. So we're going to be talking about that on Sunday. Okay. So you don't want to miss that on Sunday. All right. So back to our screen. Oh, Lord have mercy. This stuff is so good. So remember some of the negative parts where the interest rate could actually increase. All right. The interest rate could actually increase and make your payment higher. Let me show you something. If you were to take a loan and you were to consistently put, let's say you have $2,000 discretionary. You have $2,000 discretionary, and you can take a portion of that discretionary. That means after all the bills are paid, and after you have spent money even on your lifestyle budget so that you guys can have a good time. All right. So you and your family could have a good time. Let's just say there's about $2,000 left over. And every now and then you would put some money down on this loan. So let's say in the first 5 years, you had a habit of putting down half of that. All right. That's $12,000 a year. Okay. $12,000 a year. Okay. For the first 5 years. Okay. Times 5 equals an extra $60,000 on the mortgage. So we add 420, okay? 420 minus, minus, what was it? What did I say? Was it 60,000? Man, I forgot already. All right. So it is 420, let's see, 12,000 times 5. All right. Equals. All right. 60,000. So 420 minus 60,000. 420,000 minus 60,000. 420,000 minus 60,000 equals 360. There you go. 360,000. So I could have 360,000. I could owe 360,000 5 years from now. All right. So let me put in another. So we're going to open up a new tab. Okay. So 360,000. 360,000 is what I owe. All right. And my payment was before was at 7%. Let's say it goes to 8% now. Okay. It goes to 8%. And let's see what our interest only payment is now. Okay. I put in the wrong number. Look at that. Delete those zeros. Payment is too high. There we go. There we are. 8%. Now let's take a look. Interest only payments, $2,400. What my interest only payment before? $2,450. Okay. And now my interest only payment is $2,400. So if interest rates rise, but you are staying ahead of the game by putting regular payments on principal, even when they rise, your new minimum payment is going to be less. Don't be afraid of variable rate loans. Only be afraid if you make the minimum payments only. I don't care if it's if you've got a interest only loan or a regular principal and interest mortgage payment, a 30-year loan, a self-amortizing mortgage. It doesn't matter. If you regularly attack the loan, especially using the P.I.L.L method, putting the right amount of money at the right time so that you can optimize your interest savings. It's not just enough to save money. You want to save the most amount of money you possibly can. And our program has the AI systems in place to make sure you're saving the maximum amount of interest. Okay. So if you stay ahead of the game, you can save, your payments can go down even if the interest rates go up, because you owe less prematurely. How about that? If you play the bank's game, all of these things become true. Your interest rate goes up, your payment goes up. If after 10 years on this interest only period, you start to pay principal and interest, and you could have an even higher payment if the interest rate goes up. All of these things could be a negative, but if you would just make put money towards principal on a regular basis, you could be in a position no matter what happens. You don't have to worry about interest rates going up because you're going to owe less. And when the interest rate goes up, your payment goes down. How about that? Okay? Because you're ahead of the game. Instead of if after 10 years, you could be totally out of debt. You could have this mortgage paid off in 7. So the 10 years doesn't even apply to you. What if it actually takes you 9 years to do it? Okay. What if it actually takes you 9? Do you care? Here's the other thing. What if it takes you 10 years to pay off the mortgage? You still don't care because the time your introductory period runs out after 10 years. And so they can't charge you principal and interest. But what if, Lord have mercy, what if it takes you 12 years to pay it off and your 10 years actually runs out? And now you got to pay principal and interest. Okay, you got to pay principal and interest now on how much you owe. And we've attacked this loan. Okay, so now you have about you couldn't get it quite paid off in 10 years. Okay, but you have $25,000 left. Don't be laughing at me, brother AJ. You got $25,000 left on this loan. Okay, because you attacked it. You couldn't get it all paid off. All right. Interest rates are still about 7%. All right. Still about 7%. And we got an original 360 payments. So now when you get there, you have 360 payments. But even if they take 10 years off, 100, so that you have it becomes a 20-year loan. Okay. A 20-year loan. That's 240 payments. Good morning to you, Jeremiah. Okay. 240 payments. All right. At 7%, $25,000. I couldn't get it paid off in 10 years, but this is all I have left. Look what happens to your payment. Yeah. $193.82. I can't help myself. So listen, folks, do we care? Do we care about interest rates? No. Do we care about the term running out? No. Do we care about what the bank is talking about? Because most people will take this and just pay the interest only portion forever, and then it hadn't not put a dime on principal. Do you see what can happen if you know how these loans work? Oh my gosh. Can I go back? Let's go back to 1929 and talk about this a minute. Okay. Because most loans were interest only back then. It was, you had to have like 50 to 80% down. And then you had, maybe it was a variable rate loan. All right. Variable rate loan, but it was interest only. And then because it was interest only, there was always a balloon payment because they had like maybe a 5-year term or a 10-year term, a 5-year term or a 10-year term. And then at the end of the term, you had a balloon payment that was left. Now you had a choice of paying off the entire loan. You can make that balloon payment. All right. Or you can refinance the loan for another 5 or 10 years. And that's what was happening, ladies and gentlemen. Most people were getting these loans, making the interest only payment, and then renewing it every 5 or 10 years. But when the bottom fell out and the stock market crashed. All sorts of bad things happened. Most people lost their property, not because they couldn't make the payments. It was because at the end of the term, they couldn't make the balloon payment, and the banks were no longer willing to refinance the property because the property values decreased so much. There was nothing in it for the banks to keep refinancing. So they said, nah, we got to have that property. Okay. So they kicked a lot of people out of their homes, their churches, their farms. They lost a lot of their property, and the banks sold that for pennies on the dollar. So now what happened is that the government comes along with the New Deal. FDR, Franklin Delano Roosevelt, came along and said, listen, here's our New Deal. We're going to buy up all these mortgages. We're going to take government money and buy up these mortgages and then reissue them back to the original owners. All right. But we're going to give it to them on 20-year mortgages, and they're going to be self-amortizing, meaning at the end of 20 years, the loans will be paid off. Every single time you make a payment, a little more goes to principal, a little less goes to interest. Now, why would the banks go for this as opposed to the interest-only payments? And here's why. When you have these loans like this, that they are principal and interest loans, okay, they created a secondary market so they could sell the loans on the open market as mortgage-backed securities. So banks can get repaid almost immediately for the funds that they lend out, because the investors are looking long-term, okay? The 20 years of getting that interest money, it looks very good to investors, very good to investors. So because of that, America is practically out of, I think, one of three countries, all right, that has mortgages that you can get a fixed rate mortgage, and you are not required to refinance that loan every 5 years. Some countries require you to refinance every 5 years so that the investors don't lose money because of interest rate fluctuation. Okay? That's one thing that they're afraid of. But the most devastating thing that they're afraid of, this is it. Let me put something else on the screen here, okay? The most devastating thing that they're afraid of, we have mortgage, all right, mortgage-backed securities, okay? So we got mortgage-backed securities, all right? And then, so we've got, what else I'm going to put in here? Mortgage-backed securities, and then we've got to manage prepayment risk. There we go. Managing prepayment risk. Okay. The prepayment risk of mortgage-backed securities. I want to show you something here. Look at all these articles. Mitigating risk of prepayments. Risk of mortgage-backed securities. Prepayment strategies. Prepayment risk. Listen, some of these I've read. I've read this one already. I need you to read some of this. All right. Making a move to mortgage-backed securities. Listen, if you keep going, there are thousands of articles on how to manage prepayment risk of mortgage-backed securities. Now, there are people that would have you to believe that there's not much benefit of prepaying your mortgage because you're not really saving that much. If that were true, why are people who invest in mortgages, why are they so afraid of prepayment? Why are they so afraid? There's so much going on here to help them to manage or mitigate prepayment risk. It's built into the model. They know they're going to lose quite a bit of money through prepayment. So they want to make sure that they have the right mix of mortgages so that they don't lose out completely through prepayment. So if I buy a mortgage, all right, if I buy this mortgage at this is $420,000, I buy this mortgage and I'm an investor. Okay, here's how much I'm looking to make on this. On a $420,000 loan, I'm looking to make $585,000 or somewhere close to it. I do not want to put my money in and then have this loan paid off prematurely. I'm looking to get this kind of money. Now, here is why. Here is why I need you to see this, why it's so important to understand all these types of loans. Okay, can I show you here? Here's what's really going on. Remember, my interest only payment is still $2,450. All right, and this is what the bank is. This is what the banks and the investors are looking at. Especially if you get an interest only loan, they're going to get this $2,450 for 10 years. $2,450, okay, times 120 months. That's $294,000. What did they invest? $420,000, and they already have in in the first 10 years, $294,000 they've made on that money. $294,000. Let me show you what else they're looking at, ladies and gentlemen. Let me show you this. If I have a principal and interest payment of $27.94.27, let me show you something. My interest only payment is $2,450, $2,450. All right. But my regular payment is $27.94.27. Here is what investors are looking at. We're going to divide it by 2794.27 equals 87 or 88%. 88% of your payment is discounted so that even if you have a principal and interest payment of $27.94.27, when you make that payment, you get there's a discount of 88% of that money is discounted for you, so that only $344.27 of that money goes to pay down your loan. Look at that. Do you want to continue giving your money to the bank where 70 to 80 to 90% of your payment is discounted so that when you make that payment, very little money actually goes to principal? How long do you want that to happen? How long do you want that to happen? Would you like to know how you can optimally beat the bank at its own game? Listen, they have a system where they're discounting what you're doing. Can I give you an example of that? Let's say you have a backyard swimming pool and you're trying to fill up that pool, but the garden hose you're using is not long enough. So now you're filling up your bucket, and now you're walking your bucket over to fill up your swimming pool. But there are holes in your bucket. So by the time you get there, you lose 88% of the water. And now you pull the rest in. How many more trips will you have to make if every time you fill up your bucket with water, you lose 88% of the water? And you're only putting in, so let's see, if I have 100%, I'm losing 88%. Look at that, 12%. You are working hard. If this is your mortgage, you're working hard so that at the beginning, only 12% of your money is paying down the principal. How long are we going to be stuck in a system like that? And it only goes up slightly. It only goes up slightly where every single month, a little more money goes to principal, a little less goes to interest, a little more. Okay. After 1 year on this mortgage, your interest payment goes from $24.50 down to $24, $27, $25. So if that is my new interest payment, so okay, 24, 27.25, all right? And now we're going to divide it by our regular payment again. Divide it by 2794.27. Look at this. Yeah, 87. I was at 88% of my money going, I'm losing 88% of my money. Now here I'm losing 87%. Oh my gosh, 87%. So I go from 12% of my money going to principal to 13% of my money going to principal after 1 year. Folks, we need to look at this stuff a different way. How long do you want this to continue? The reason why real estate investors love to do business in America when it comes to these mortgages is because when you make your payment, all of the money, Lord have mercy. If your payment is $27.94, all of that goes to the investor, every single dime of it. That they don't get some money or and then you get some. No, your mortgage is discounted every time you make a payment. It just gets discounted a little less. So how should we look at that? Think of it as your swimming pool again. And when you get a mortgage, you have, especially this mortgage, you have a $420,000 deficit. You have a $420,000 hole that you're trying to fill up. Okay, so your payment is $27.94. You're trying to fill that hole up so that you can pay back the $420,000. But each payment is discounted by 88%. That's what's happening here. So while you're trying to fill up the hole of a deficit, and the bank says, okay, I'm going to give you a plan of a payment you can afford, but it's a payment you can afford, but it's so expensive to maintain. So expensive. So look at this. So if I can get you in a system like this, where I can discount your payment so severely, and you don't even care because it's a payment you can afford. So why are investors so afraid of prepayment? Here's why. They're looking to get all of these payments. They're looking to get all of these payments in this first year. $24.50. They're looking to get every single one of these payments, but the discount up here is a much bigger discount in their favor. They love this. They love it. So when you get your mortgage payment and you don't do anything about it, you just make the minimum payment. It's, I get this discount. So they have to pay me 360 times because of the discount. What if you got the discount instead? Okay, here's why they're afraid. If you make this mortgage payment here and you give them an extra, let's say Brother AJ talked about $350, okay, before, but you make an extra payment of $346.28. These are the cheapest principal payments you have right now at the beginning of the loan. And your interest discount is the most it can possibly be at the beginning of the loan. You can turn that around by doing something as simple as this. I make my regular mortgage payment. I give the bank an extra $346.28 in that same month. I'm paid down to here, and my $346.28 is not discounted at all. The bank doesn't discount it. But what just happened? I just discounted how much the investor will receive, because here's my new payment is on line 3 of the mortgage. I just discounted what the investor was going to get by $2,447.99. That's money they will not receive from me. That's why they're so afraid. After 1 year on this mortgage, after 1 year, if you add up all of the interest and all the principal, after 1 year, you have paid down this loan by $4266.41, and your money was discounted by $29,264.83. So when we add it together, okay, this is how much money you paid out in 1 year on this loan. $29,264.83, plus how much money was allocated to fill up the deficit, okay? $4,266.41 plus $4,266.41 equals $33,531.24. This family paid out $33,531.24 very easily because it was a payment they could afford. This is how much they paid towards their mortgage in 1 year. But those payments were discounted by $29,264.83 as they tried to pay back the deficit that they have. They have a $420,000 deficit. They're trying to pay it back. The money that they gave was discounted by $29,000. So that means only $4,266.41 went to principal. So it cost them $29,000 to pay their loan down from $420,000 to $415,000. Why are investors so afraid of prepayment? Why are they so afraid? Here is why. Once you understand this, if I were to prepay this up front, whether it's a principal and interest loan or an interest-only loan, I save a ton of money. I save a ton. Watch this. So here's how it works. Remember our math. So I owe $420,000. I'm going to choose, if I have the money, I can give them $4,266.41 on line 1. I don't have to wait and pay it this way in 12 monthly installments. I can make my regular mortgage payment and then give them $4,266.41 on top of it. So we're going to subtract $4,266.41. I'm down to $315,733.59. That's exactly what's right here. But I'm there in 1 month. Okay? I need you to see what happens. Why are investors so afraid of the P.I.L.L method? Why are they so afraid of prepayment? Why are they so afraid? Here's why. So if I do this, I prepay this, my next mortgage payment is based on this number, okay? On the 415,733.59. So we take our 7%, 0.07, divided by 12 equals this number multiplied by 415,733.59. All right. My next interest payment is $2,425.11, which is right here. I go from this interest payment down to this interest payment. Here is how most people understand this. I need you to see this and watch it clearly. I had this explained to me by someone who goes around the country teaching finances. Everything else they're teaching is great. Okay, I went to California to listen to this guy. But here's what he told me. Here's what he told me. You go from here down to here. So here's my original interest payment. Here's how much money you saved. So if you start out with $2,450, okay, $2,450, and your next interest payment is $2,425.11, so you subtract $2,425.11. It says, Don, all you saved was $24.89 by prepaying. Are you kidding me? Someone who's educated, someone who is teaching people how to make money in investing, doing very well in what they're doing. I mean, they charge quite a bit for their courses. They charge a ton of money for all of this information, but this is how they understand prepayment. I knock off a year's worth of payments, and all I'm saving is $24.89. The difference between $2,450 and $2,425.11. Okay. And all they have to do is this. Let me see what we have in here. Colin Black says, can a bank refuse to take extra money on the principal? No, they can't refuse. Do you know how I know? You know how I, because it's in your mortgage papers. All right. Let me see if I've got this prepayment. All right. Here is prepayment. Okay. Right. Okay. Right. Okay. You have a right to prepayment. Okay. Prepayment. Your right to prepayment of principal. All right. So we can bring this up here. Let me bring this up here. Okay. Okay. RIGH, right to prepay principal. Okay. In principal, P.A.L. Okay. There it is. Okay. Okay. Prepayment privilege. The right is not, it's a right. It's not something that you have to ask for permission. This is written into your contract. The right a consumer has to pay part or all of the debt before its maturity ahead of schedule. You have a right to do this. It's written into your contract. Okay. So pull out your mortgage papers and you'll find it. All right. You have a right to do this. You don't have to ask for permission. So let me ask you this. No matter how much you owe right now, let's say it's $250,000. If you stroked a check, if you had $250,000 and you took this to your bank or mortgage company, would they turn down your $250,000 payment? What do you think? What do you think? No. We don't want the $250,000. We want you to make all these other payments. No, they have to accept it. They're willing to accept it, and they want to accept it. and they'll accept it. Why? Because they can lend out 10 to 1. For every dollar they have, they can lend out 10. You give them $250,000, you just gave them $2 million, $2,500,000 to lend out. They can lend out 10 to 1. They don't care. The banks don't care because they sold your loan to an investor. The investor cares that the loan is paid off, but the banks do not. If you have Chase Bank, if you have Bank of America, if you have or whatever bank you have, and you got a mortgage there, they sold that mortgage within a week or two. It's gone. Okay. Now you may be paying them, but somebody else owns the loan. You may be paying Bank of America, but somebody else owns the note because they sold it to them. And Bank of America is charging them a fee to manage that loan for them, to collect the money, and then Bank of America sends on the payment to them. Okay, they just want to be in investing. They don't want to be a debt collector. They're paying the banks to be a debt collector. That's another form of income for the banks. Debt collecting. All right. And so the investor can continue to get discounted payments for 10, 15, 20 years, 30 years, for however long they can. Okay. So that's what's going on. So I got another question here. But even if they accept prepayment, can't they still possibly charge a prepayment penalty? Yes, they can. Okay. And you have to understand prepayment penalty. All right. So let's so here's this question here. Can they still have a prepayment penalty? Yes. So what you have to do is figure out, what is the prepayment penalty? That's the question you need to ask. And what makes it worth paying the penalty if you know how much interest you can save? All right. So let me give you an example. I'm going to do this and kill two birds with one stone. All right. So remember when I was showing you here that this expert says that the difference here is between this interest payment and this interest payment is only $24.89. That's all I saved by prepaying this $4,266.41. That is what's being taught around the country right now. No wonder most people don't prepay. No wonder most people don't understand how this works, because there's so much faulty information. So all you have to do is this. Here's what you have to do. Okay. You get Brett Whistle. All right. And you say, well, this is what I'm working with here. Okay. Okay. This is what I'm working with. So if I'm paid down to here, why don't I just put it in a brand new amortization schedule and then do the math? So we're going to take this, we're going to duplicate this. Here's our new amount is this. We paid it down to here. Paste it. Now I've never been strong in math, okay? Because I found out later that I have ASD. I'm on autism spectrum disorder, and I've never really been strong in math. But when I see this, I see the pictures, and this totally makes sense to me when I look at this. All right. So I see what the experts are not seeing, and I'm passing that information on to you. So here is the new amount that I owe. Okay. I didn't want to do that. I took the payment. I meant to take this out. Okay. I meant to take that out. So let me go back. All right. Let me go back and duplicate this tab again. Let me get rid of this one, or duplicate this tab again. All right. And then put in, there you go, put in this amount, and we're going to, wait a minute here. There's my mortgage. Duplicate. All right. Put in the new payment. take out the comma. I want to remove the 360. I want to keep the same payment, okay? We have the same payment. So when we calculate that, I have 348 payments left. Does that make sense? 348 payments left because I owe less. So now let's take a look at how much interest I have left to pay. 556,000 total interest paid is 556,672.37. On the original loan, I have 585,937. So let's put that into the calculator. Not $24, not $25. It's not $25 that I saved by prepaying. It is not. It can't be. So I put in $585,937.20. That's how much interest the bank wants. All right. And now here is my new amount on $415,733.59. How much do I have left to pay? $556,000. So let's subtract. We subtract 556,672.37 equals, there it is, $29,264.83. That's the difference between this total interest paid and this total interest paid based on 420,000, paying it down by 4,226. I'm down to here. And now that is how much interest I've just saved. Now I need to show you something. If I did that subtraction from two separate amortization schedule, my savings is 29,264.83. Isn't that the same number that's here? That's the same number that's right there. 29,264.83, 29,264.83. I'm telling experts around the country that they've been miseducated on how interest payments actually work in mortgages, and they're miseducating the public about the very same thing. How could they be so fooled into thinking that all I'm saving is the difference between this number and this number, which is about less than $25. That's all I'm saving if I prepay $4,266.41. They've been fooled into thinking that because we've never really stopped to think about it. All right. So do I have another question here? Mr. Colin Black, what do you have for me? Says, I wanted to pay off half my mortgage every 2 weeks, but my bank told me I had to sign up for a program in order to do that. Well, yeah, of course you did. Of course you have to sign up for a program to do that. Do you know why? Generally because if you sign up for a program to pay your mortgage every 2 weeks, they generally charge you for that. Let me tell you something about mortgages right now. If your mortgage is this much, hey, 27, your principal and interest, we're eliminating taxes and insurance from this conversation. 2794.27 divided by 2 equals 1397.14. That would be your mortgage payment every 2 weeks. So in the first week, you give the bank $1397.13. Now, what happens when you pay them in week 1? Okay, you pay them on the first day. What happens to that? Do you know what they do? They hold that $1,397. They just hold it until the 15th, and you make the second payment. And now they apply the whole payment. You don't save a dime. You don't save a dime when that happens, because they don't apply anything to principal and interest until they receive a whole payment. Here's how mortgages work. They must receive the whole payment first, and then you can do something else. They don't do anything until they receive the full payment. So, Don, how does a biweekly payment system work then? Well, just like if you get paid every 2 weeks, every 6 months, you get 3 paychecks in a month. So what happens is every 6 months on a biweekly payment, you will make 3 payments. You will make 3 of these payments, 13, 97, 14. You will make 3 of those payments in the same month. The 2 of them go to make the regular mortgage payment. This third one, 13, 97, 14, goes straight to principal. And you do that twice a year. So that means you make 13 payments a year. That's how a biweekly payment works. Why would anyone do a biweekly payment? Because they don't understand it. A biweekly payment, the most it can do for you is knock off 7 years. That's the most it can do for you. It's somewhere between 4.9 and 7 years. Instead of saving 7, why don't you work with the P.I.L.L method and save 23? We'll knock off 23 years and you're done in 7. Way more effective, just as easy to do. All right. And you're going to get the benefit of this because every 6 months, look what happens. If I make a payment here, all right, and then I go down and every 6 months, do you know that while I'm waiting to put money on the extra money on the mortgage, I'm paying 1, 2, 3, 4, 5, 6 of the most expensive interest payments I have before I can put money on principal. And then I've got to wait another 6 months. 1, 2, 3, 4, 5, 6. The bank is discounting the investor is discounting my payment for 6 whole months before I put any money on principal. Now, why does a bank want to sign you up for this? Let me answer that for you, Mr. Black. Why does a bank want to sign you up for this? Because when they sign up for it, generally, they will not do it unless they can do an automatic payment. They want to automatically draft your account to do this. And guess what? Most of them charge you to draft your account. So if you're only making a payment towards principal every 6 months, that's 2 months out of the year that this is actually helping you, but they're drafting you 26 times. So whatever the fee is, 24 of those times they're drafting you does nothing for you. Only 2 times out of the 26 times they're drafting you every year is only helping you. So you're paying a fee for 10 months out of the year for absolutely nothing. Only 2 months out of the year is actually helping you. That's why they want to sign you up for that. Colin Black, find out if that's true. If you want to know more about how this works, listen. We're going to play Mr. Eric Thomas one more time, and let's see what he found out. I need you to see this. All right, let's see what Eric Thomas found out when he decided he wanted to do something different about his mortgage. Watch this.
Listen to me, y'all. But one of his mentees took us through one of their programs, and I paid off my mortgage. But guess what happened? My marriage went to a whole nother level. And you know why? Because my wife is a security freak. And even when I blew up, my wife would be like, oh, you blew up, but how long is you gonna keep making this kind of money? I was like, I don't know, forever. She's like, you sure? Because I'm gonna keep my license as a nurse just in case you don't. So when I paid the house off, my boy was like, you ain't gotta do that, you can do this. But when I paid the house off using that program, it took the stress level all the way down for my wife because we no longer had a mortgage. Does that make sense? That thing that was coming every month, that was getting on her nerves, we didn't have that no more. And so she was at rest.
Folks, we don't want you to be miseducated anymore. We don't want people telling them that if I prepay on this mortgage $4,266.41, that my interest savings only come to $25. That's ridiculous. If I look at this and this, of course, that's what I see, and this is what I've been told. And if I don't know the math, if I don't know how an amortization schedule works, and why are we so easily fooled on this thing? Because how an amortization schedule works is not taught at any level of financial education. So this is why, watch this. Here we go. This is why we use an AI system to beat the bank at their own game. This system is created so that, let me make this just a little bit smaller. This system is created so that you can save the maximum amount of interest per dollar. Some people will tell you, Don, all you have to do is pay extra money towards your principal. Yeah, but it's more difficult than that. When you pay the right amount, you can increase how much interest you save per dollar. It's called optimized interest cancellation. Anybody can cancel interest. Anybody can pay more, but not everybody can increase the amount of interest that they're saving per dollar. In fact, if you pay too much at the wrong time, you're missing out on other opportunities, which means you're saving less per dollar if you pay too much. If you want to know more about this, if you want to know more about how to do that, ladies and gentlemen, I need you to do this. I need you to go to ice10k.com. All right, Colin, ice10k.com. All right. If you want to know more about this, get a savings and earnings report. It's free. It's free. Click on, scroll down underneath ET's picture and click here. Get a savings and earnings report. Not only will you know the month, day, and year you could be debt free on your mortgage, your credit cards, your student loans, your car loans, put it all in, and we'll show you how you can save tons of money in interest. And then we'll show you how the interest saved from these loans actually pays for your lifetime program. We want the bank's money to pay us. I'm going to show you how you make your bank pay. Okay. I'm going to show you how you make your bank pay. All right. So if you want to be done in an average of 5 to 7 years, and if you want to know upfront how much interest you're going to save and how much time you can save, fill out this information. It's in 2 steps. Just follow the instructions here. Get this form. It has 2 steps, blah, 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 blah. Read what it says here. All right. And then in step 2, you're filling out the financial form. How many mortgages do you have? How many credit cards do you have? Put all the information in that we're asking for. Your income, put it in. Our staff will get that for you. All right. And what we're going to do is this. If you do this, you can get this form. We'll give you the form. It's a 2-page form. We'll do all the work on it. We'll send it to you for free. You can know what's happening. Now, what if you like what you see and you want to say, listen, I want this for me and my family? We will show you how much of the money you're no longer paying the bank, how much we'll pay for this program. And you'll have it for the rest of your life. And you can use it over and over and over again. We have people that are paying off their 3rd and 4th mortgage on this program, and they paid us once years ago. And they don't pay for updates. Listen, we're constantly updating and improving the program. Okay. And listen, we've got some exciting things in the hopper that we're going to make some additional improvements on the program that you're absolutely going to love. So get your savings and earnings report, get that, and then so that you can understand what's going on behind the scenes using this program to beat the bank at their own game, save the maximum amount of interest that you possibly can, all right? And take that money that you're no longer paying in interest and do this with it. Let's go to reports. Let's go to net worth. Take that money you're no longer paying in interest, okay? Wealth accumulation, okay? This year is 2024. Okay. So this loan is supposed to be paid off in 2054. Let me show you what happens if this loan, if we do what we need to do by 2054, this family can take that money that they're no longer paying the bank, invest it, have a paid off house, and by 2054, they'd have an extra $862,000 invested, and that's at 1% earnings on their money per year. That's at 1%. The average across the country is 6 to 7%. So a family on a W-2 salary can add over $1 million to their net worth just by not giving the bank all of that interest. Why would we? Why would we not want to tell the bank? Here's what, remember what I was telling you why real estate investors are so afraid of this program? So afraid of prepayment? If they're looking to get $585,000, okay, let's just say $585,000, just divide it by 3. Okay, divided by 3. There we go. That's $195,000 lost to them. $195,000. Listen, folks, I need you to wrap your mind around this before we go. People are putting a lot of money down to get a mortgage right now. They're putting money down to get a mortgage so that they can be overcharged by 139.5%. We're going to come in, and they're signing up for this mortgage, and they put a lot of money down to get it. We're going to come in. We're going to show you how to save about $200,000 in interest, taking money that you already signed up and said, I want to pay the bank. I want to pay them $585,000 in interest to borrow $420,000. This is what they've signed. And when it's all said and done, which means I'm going to pay for my $420,000 house, $1,005,937.20. When you sign a mortgage like that, you're paying them a lot of money up front in order to do this. Why not? Why not take some of that interest money, that $585,000, pay for a program that's going to save you over $200,000 to $250,000. You don't have to pay them using money that you've already said I want to give to the bank. This is a no-brainer. No-brainer. All right. So I want to let's get together and let's talk about this. Colin says, "What are you saying, Colin?" I talked to a friend of mine about your program when I saw your commercial one morning, and he ended up signing up for the P.I.L.L method. Oh, you talked to somebody and they signed up, but you didn't sign up? Come on, Colin. Listen, I thank you for that. I really do. So let's you start getting the benefit of this. All right. And let me tell you what. Here's what else I'm going to do for you guys today. And we're going to put our phone number in. Usually it takes to set up an appointment with me. It's $150 for an initial consultation. $150. Call today, 256-886-1867. 256-886-1867. That's just for today. That's Friday, May 3rd. Okay. And ask for me. You can, I'll call you back. Leave a message. I'll call you back. That's just for today. And I'll take one question. How about that? You do that today. Let's see how we can help you undo this mess that we're in right now. The banking system took a interest-only loan that if we knew what was happening, we would have been better off. But now we have a principal and interest loan, a self-amortizing loan. Let's see how we can make the best of a bad situation and pay those loans off in 7 to 9 years without without sacrificing lifestyle. Let's get that done, okay? And then also, don't forget to, when we go back, don't forget to get the book. There's a button there, ice10k.com, ice10k.com, get the book. And you click on this button so that you can get the book, okay? So we're gonna put the book on the screen, and you can, it's been a bestseller on Amazon at least 6 times. Get the book so that you can start understanding the basics and start teaching your children. Get the book, watch the videos on YouTube. Oh my goodness. And you can learn quite a bit. And then you'll see why you need an opportunity cost calculator to beat our computers, beat the bank's computer to the punch. They have a computer that's robbing you of your, I'm sorry, the investor's computer robbing you. This whole system is robbing you of your family's legacy. Our computer will help you to preserve it. And there is no other program on the planet. I want to stress this part. No other program on the planet can save you more interest than us. We're going to save you a lot more than anybody else on the planet. If you find a way to save more money, we will give you your money back. This, the P.I.L.L method, is the very best interest cancellation program on the planet by far. Nobody beats us. And if anybody wants to challenge me online, bring your system. We'll go on, we'll do a whole show, your system versus the P.I.L.L method, and we'll show you that this one will save you more money than any other system on the planet, because our system is the only one that focuses on optimized interest savings. Other systems focus on how fast you can pay down the principal. We focus on how little interest you're supposed to pay to manage your debt. The only ones. And it totally makes sense, doesn't it? Well, ladies and gentlemen, I need to get ready to get out of here, but I want to show you what we have coming up on Sunday. Okay, let's put that on the screen for them. Do you want to learn how to sell mortgages at no license required? Okay. Do you want to learn how to sell mortgages? You can sell multi-million-dollar mortgages. Let me show you just a little something here. Let me show you something, just a little something. Even if the mortgage is $700,000, you put together a mortgage package. We got a guy that's coming in that teaches you how to do this, how to put a mortgage package together and get 3 points. Okay, times. You could make, on that loan alone, you would make $21,000 in commissions. $21,000 in commissions. And I need you to see this. A $700,000 mortgage at 3 points, you would make $21,000. And put it back on the screen so people can see it. Here, I want you to see it one more time. No license required to do business purpose lending. If it's for business, you don't need a license. Oh my gosh. So we have Jonathan Bing coming in on Sunday to show you, and he's going to show you give you some banks that you can sign up with and give you the basics so that you can start making this kind of money. And he's also going to give you the secrets on some of the fees that brokers charge that you can also charge. Okay. Let me tell you, if you're watching the news, money is tight. But there are private bankers out there that are chomping at the bit to get their money out and get it working. But they can't advertise. It's against the law. They need you and people like you to get this information out there. And I think Jonathan will be able to tell you there are less than 10,000 brokers, 10,000 brokers across the country right now that can do business purpose loans. Less than 10,000. This is an area that is not saturated. and is very much needed. We're going to be talking about that on Sunday. So, folks, I'm getting ready to get out of here. So don't forget, get your principal and interest. Don't forget to get your savings report. Get it today. Start filling that information out. Get my book. All right. And also, you also want to subscribe to the YouTube channel, like the videos. Okay. And also share the videos and comment on the videos. Okay. Do all that. Do that. It's the least you can do for all the information that we're giving you. But we're doing something special for today. Call 256-886-1867 and ask for me, and I'll call you back. Okay. Just leave a message. I want to have Don call me back. That's all you have to say. Have Don call me back. And then I can answer a couple of questions for you. I want to thank you very much for showing up. Don't forget to be here on Sunday at 9:30 a.m. Eastern Time, 8:30 Central for selling mortgages, no license required. Okay? Selling mortgages, no license required. All right? Thank you so very much. We'll talk to you on Sunday. Listen, have a happy Sabbath. Don't call me tomorrow because I'll be in church. Okay. Have a happy Sabbath to everybody that applies. Thank you very much for being here today. We'll see you again on Sunday. Bye-bye. How many want to know how to pay off all of your debt in an average of 7 to 9 years? You can do all of this without refinancing, without change to your budget, without sacrificing lifestyle.
Me and my husband do the P.I.L.L method, and last year we were able to pay down $33,000 on our mortgage without feeling like we were poor. We still did tons of entertaining things and enjoyed our family.
You don't have to eat beans and rice every day. You don't have to cut up your credit cards. You don't have to drive a 30-year-old car. You don't have to sell pizzas at night to pay off your mortgage. All you need to do is pay the bank less interest. That's what we're talking about today. Here is what P.I.L.L method stands for: prepayment of principal, isolation of principal amounts, leverage, and liquidity. You understand it? You have a way of getting out of debt more efficiently. The interest rate you're quoted is not the interest rate you pay. You think you're buying a $500,000 home. The true cost of that home is what? $758,000. Total interest paid as a percentage of principal, 51.777%. That's what's going on with this loan. The ability to read and defeat an amortization schedule is not taught at any level of financial education. I need you to understand the power of a penny. You will not hear what I'm talking about from Dave Ramsey. Do you know why? Because I own the copyright. I literally wrote the book.
But Don has some valuable information that can contribute to the quality of a person's life. And it only costs you a few dollars. It's his book. Why not get that?
I'm going to go through the P.I.L.L method myself with some of my investment properties. So I'm going to link up with Don, and then I'm going to sit down with him, show him my investment portfolio, and see how I can eliminate interest.